markets are overbought. We are due for a bit of correction here, at least consolidation, to help bring these moving averages up to the markets, or eventually the price has to correct back to this moving average. These deviations, as we talked about previously, are getting pretty decently extended. Here's what you need to know before the bell. On Friday, markets were a bit weak on Friday, traded sloppily most of the day. Not a big down day by any stretch of the imagination, but that was all that options expiration that was going on. Not surprising, we saw a bit of volatility. As we talked about on Wednesday, the markets had gotten very, very overbought, and the market was due for a bit of correction. And we saw that on Thursday and Friday. Had a bit of a sell-off on Thursday, a little bit more on Friday, sloppy trading on Friday. It started to reverse some of that overbought condition. Again, not a tremendous amount. Now, this is in particular the technology sector that we're taking a look here. But again, if we take this and look at the S&P 500, you can't really tell much of a difference because pretty much technology has been driving the S&P. In fact, it's one of the largest. It's the largest sector in the S&P. It's got most of the heaviest weighted names in the S&P are technology stocks. So pretty much you can overlay both of these indexes and they look just alike. But again, same thing here. Even on the S&P itself, seeing a bit of a sell-off. Nvidia, of course, was everybody's big concern over the weekend. As I said, is that they had sold off for a couple of days. Had decent sell-offs, 3-4% over the last couple of days of the week. And had a lot of people start like, oh, is the peak of Nvidia in? Probably not. Had a lot to do with that options expiration. But again, markets are overbought. We are due for a bit of correction here, at least consolidation, to help bring these moving averages up to the markets, or eventually the price has to correct back to these moving averages. These deviations, as we talked about previously, are getting pretty decently extended. Again, a good time here to take some profits, rebalance risk, add some hedges to your portfolio if you want. There's a lot of optimism in the markets right now, and that's certainly not surprising because of this action that we've had here really since that correctional process that we had back in April. People have gotten very, very excited about the market. Allocations are reaching some of their highest levels on records for retail investors. Again, just very, very optimistic about the markets. That's typically a good time to be a little bit more risk averse. Remember, one of the bases of contrarian investing is when everybody's on one side of the boat, you kind of want to be on the other. Not entirely, right? You don't want to be shorting the entire market, but being a little bit more cautious when everybody is very, very excited about the markets and potential upside. Now we're seeing, all these upgrades to year-end estimates. Goldman Sachs 6,300 by the end of this year, right? We're at 5,400 right now. So Goldman's expecting this market to rally to 6,300 by the end of this year. I'm not saying that can't happen, but this is typically what happens. We came into this year with targets for the year end around 4,800 to 5,000. Now these are all getting ratcheted up to 6,000 to 6,300 because of this market advance. Again, everybody's very excited. This is very similar to what we saw last year in June, halfway into July. Markets were rallying, and then we had that 10% correction between July and September. So again, a very similar market environment to just almost kind of replaying last year. We'll see what happens this summer. But again, a little bit of risk management here certainly would be advised. All right, that's what you need to know before the bell this morning.